today's trading session. In fact, that stock has given good returns on a year-to-date basis. It's up around 20% on a year-to-date basis. We have with us the management of the company. They've approved setting up a new unit in Aurangabad. Pankaj Podar, the CEO of the company, now joins in to talk exactly about that. Pankaj, hi, thank you very much for taking the time out. So this new line has a capacity of around 36,000 MT per year with an investment of around 250 crores, we understand. So give us a sense in terms of where you're getting this money and why do you need to set this plant up?
Yeah, so good morning, everyone. We are setting up this plant at Aurangabad in Maharashtra. And for the first time, we are entering into PET thermal, PET specialty films. And the total investment is 250 crores. And, it is being funded through a mix of debt and internal accruals.
Was that mix, out of 250 crores, is it largely internal accruals or is it largely debt?
I would say it's in the ratio of 75-25. So debt will be roughly 75% of the total investment and internal accruals will be 25 to 30%.
Okay, so then let's talk about the commensurate returns in that case. I believe that you would be completing the commissioning in this year, this financial year itself. How much do you expect then it starts adding to your top line? And with this new product coming in, what does that do to your blended margins?
Yeah, so it will start in actually Q3 of next financial year, which is 18-19. Typically, there's a good time required to install these large lines. And, it should add roughly 300 crores, 350 crores to our sales, depending on the mix of the products. And as far as the margin is concerned, it should give us a very good margin because it's largely specialty film that we are going to produce from this line.
So net, by the end...
In fact, the company's focus...
Go ahead.
Yeah, sorry. In fact, the company's focus is largely specialty films, and therefore, the margins from this new line should be pretty good.
Okay. So net, where do you think your long-term debt levels would be, say by FY18 end and FY19 beginning? It's currently at around 308 crores.
So the company... Yeah, so the company has always been very conservative in terms of raising debt. Typically for us, roughly a debt-EBITDA ratio of 3.5 is what we look at most. And therefore, even for this line, this line, we expect the debts to stay within that range or even lower than that because our internal cash accruals is quite strong. And as far as FY18 end, we expect debt to be roughly 500 crores, though it's very difficult to give projections because it's also dependent on the market. But definitely we would stay somewhere below 3 by FY18 end.
How's demand overall? Because 9 months revenue was down around 24%. What's demand like?
Yeah, so the demand is going very strong. In fact, we just started our BOPP line, which is, almost running on full capacity already. Demand is growing at 12%. In fact, the revenue drop that you had seen is largely driven by drop in raw material prices. And in our industry, raw material prices, whichever way it moves, these are typically passed on to the customers. So whatever revenue that you saw is actually driven by pricing rather than anything else.
So, sir, now crude is back at 52. How are prices moving for you, both on the raw material side and then, what kind of a pricing leeway do you think you'll have in the months to come?
Yes, so the polypropylene cost, which is, kind of linked to oil prices, is largely, in tandem with the oil. In fact, for last 1 or 2 months, it's been slightly at a higher level. And in fact, the sales price also are moving in line. In fact, the commodity margins, which were going very low, in fact, from March has seen a good pickup. And that's largely because, for 3-4 months, there was a demonetization impact as well on all kinds of, volumes that we do. But from March onwards, we are definitely seeing an upswing in that.
So I just want to come back to the point on margins. Colleague Naveen tells us that your overall margin was at around 9.4, 9.5%, 9-month margin for FY17. Now, as and when the specialty line gets added, you get 300 crores at least on the top line. If you could just give us a quantified sense on the margin expansion, because this is a specialty product, so typically it should take your overall margin higher as well. By how much?
Yeah, so as far as the specialty growth is concerned, even in the fourth quarter, we had the best ever growth on the specialty films, which was a good 20% on our total sales on YOY basis for the last quarter. As far as this line is concerned, we are looking at largely into specialty films. And from a margin perspective, though it's a very difficult forecast, but it should be somewhere in the range of 18 to 20% at least.
Okay. All right, fair enough, Pankaj. We're going to let you go on that note. Thanks.